I just want to say hello, everyone, and welcome to our first webinar of fall 2024. I am Rachel Helms. I'm one of the assistant directors here in Alumni Relations at Middle Tennessee State University. Thank you so much for signing up today for today's Investment Basics. We are thrilled you can join us. We're excited about partnering with Ascend Retirement and Investment Services. Our featured speaker today is financial advisor Lee Baker. He's a 2006 graduate of MTSU. Lee, thank you so much for being here. I'll turn it over to you to get started here in just a minute. I just wanted you all to know that I'll be monitoring the chat for questions, or feel free to throw any of your questions in the Q&A box. We are probably going to hold most questions till the end, but please feel free to ask them. Lee, if you want to get started, take it away.
Thanks, Rachel. Hey, I appreciate everybody coming today. Thank you so much. Good afternoon. I think I can officially say that now. I'm looking forward to giving you guys this presentation, and just like Rachel said, if you want to have any questions or anything like that, hold them to the end. I look forward to answering those. So yeah, let's get started. So in this presentation, we're going to discuss the basics of investment planning. We'll start by discussing some fundamental investment concepts. Then we'll review some of the investment options that are available to you and consider some general investment strategies. Finally, let's spend some time discussing how you might go about allocating your investment dollars. In the end, I hope that this overview will assist you in thinking about your own investment needs and may help you determine whether you benefit from working with a financial planning professional. To begin, let me pose a question. What does investing mean to you? Some of you may associate investing with speculating, gambling on the volatility or uncertain value of assets in the hope of attaining potentially higher returns. For example, trying to time the market in order to make a quick profit. Others may see investing as more of a long-term, methodical effort to save for the future. In fact, investing is a little bit of both. All investing involves a certain amount of risk, including the potential loss of principal, and there can be no ironclad guarantee that any investing strategy will be successful. Investing also involves the potential of growth of your money over time. Consider investing a carefully planned and prepared approach into managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. An important concept to understand when it comes to investing, and this one's been a big part of our lives here lately, is the impact of inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the annual average rate of inflation since 1914 has been approximately 3%. At 3% annual inflation, something that costs $100 today would cost $181 in 20 years. So let's say you have $200,000 stashed in your mattress. Assuming an annual inflation rate of 3%, that $200,000 would buy you just over $108,000 worth of goods in less than 20 years, and less than $60,000 in purchasing power in 40 years. This means that if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. It also means that the real rate of return on your investments may actually be less than you think, something you need to take into account when you start investing. Inflation has a general effect of reducing the real value of your investments over time. Compounding has exactly the opposite effect. Anyone who has a savings account understands the basics of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. Many people, however, don't fully appreciate the impact that compounded earnings can have, especially over a long period of time. So let's say you invest $5,000 a year for 30 years. After 30 years, you will have invested a total of $150,000. Yet, assuming your funds grow at exactly 6% each year, because of compounding after 30 years, you will have $395,000. The rule of 72 is a quick way to help you estimate how long it will take for an investment to double in value through compounding. Divide the number 72 by the rate at which the investment will increase in value. Excuse me. The result is the number of years it will take for the investment to double. For example, if the expected annual return on investment is 3%, it should take about 24 years for the investment to double in value. You can also use the rule of 72 to determine the rate of interest you need to double your investment in a given number of years. Just divide 72 by the number of years. For example, if you need an investment to double in 4 years, you would want to have an annual return of 18%. So the sooner you start investing, the more time your investments have for potential growth. Waiting too long can make it very difficult to catch up. For example, invest $3,000 at the end of each year, starting when you're 20 years old, and you will have accumulated almost $680,000, assuming a 6% annual growth rate and no tax by age 66. If you wait until 35 to start investing $3,000 annually, you'll accumulate only about $254,000. And if you wait until 45 to start investing, you'll accumulate only about $120,000 by the time you're 66 years old. It's never too late to start, so don't be discouraged. I'm simply trying to illustrate the importance of acting sooner rather than later. The first step in any investment plan is to identify your goals. What are you investing for? Many of us invest to accumulate funds for retirement or for child's education. Others invest for shorter term goals, perhaps a down payment on a home or a new car. Still others invest to build a fund that they can access for unanticipated financial needs, illness, accident, or job loss, for example. Of course, you may have all these things as investment goals or something that I haven't mentioned at all. If you do have multiple goals, think about how you might prioritize them. Once you've identified and prioritized your investment goals, consider the time horizon associated with each goal. Generally speaking, all else being equal, the longer your time horizon, the more aggressively you may be willing to invest. That is, investments that carry more risk because they offer a greater potential for return will tend to be more appropriate for those with longer term investment horizons than those with shorter term investment horizons. Why? The longer term investment horizon, the longer the term investment horizon, the more time you'll have to recover from any investment losses. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have with it when it comes to risk. You can completely avoid risk when it comes to investing, but it's impossible for you to manage it. There are two aspects of risk tolerance to consider. One, the capacity of your investment plan itself to absorb losses. And two, how comfortable you are personally with risk. The first aspect can be quantified. The more flexibility your investment plan has when it comes to potential loss, the more risk your plan can tolerate. For example, as we've discussed, a long investment time horizon may allow you to take on more risk than a short time horizon. The second aspect, how comfortable you are personally with risk, is more of an emotional measure and depends on many factors, including your objectives, life stage, personality, and investment experience. Some investors are comfortable with a high degree of risk, while others can tolerate only minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, as well as how your investment dollars should be allocated among different investment classes. Investors are typically grouped into three categories for purposes of discussing risk tolerance: aggressive, those who have a high degree of risk tolerance; moderate, those willing to accept some degree of risk; and conservative, those who are risk averse. When it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, the lower the potential for return. For example, putting your money into a bank CD may have little risk, but it also offers less potential return than purchasing common stock. This is true for investment portfolios as well as for individual investments. The more aggressive you are as an investor, the more risk you may be willing to take. More risk means a greater potential return, but also a greater chance of loss. Conversely, the more conservative you are as an investor, The less risk you're generally comfortable with, less likely means lower potential returns, but less likelihood of loss as well. This is known as the risk return trade-off. As much as we would like it, that we can't have it all. There's a relationship between growth, income, and stability of our investments. And when we move closer to one, we automatically move away from another. This is a dilemma that all investors face. The key is to try to maximize returns at a level of risk that you're comfortable with. So there are several general categories of investments to choose from and countless specific investment options within each category. We're going to discuss cash alternatives, bonds, stocks, other investments, and funds that pool your money with that of other investors, such as mutual funds and exchange traded funds. Before we start talking about investment options, however, let's take a moment to clear up a common misconception. Some of you may think of your 401k plan at work as an investment. Well, it's not. A 401k plan is a tax-advantaged vehicle that holds individual investments. The same goes for IRAs, 529 plans, and Coverdell ESAs. Think of these tax-advantaged vehicles as buckets that can be filled with individual investments. Investments that are held in these vehicles get different tax treatment than investments that are held outside these vehicles. We're not going to discuss the tax treatment of investments at all today. However, it is an important subject, especially since the tax treatment of long-term capital gain and qualifying dividends is typically more favorable than that for ordinary income. Since you'll need to understand how different investment options are taxed to make good decisions, you should discuss this issue with a financial or a tax professional. Cash alternatives are relatively low risk, short term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives to provide you with relative stability, to maintain a ready source of cash for emergencies or other purposes, or to serve as a temporary parking place for assets until you decide where to put your money longer term. A few examples of some cash alternatives include certificates of deposit, money market deposits, accounts, money market mutual funds, and U.S. Treasury bills, also known as T-bills. Each option offers different rates of return and varying levels of liquidity. Also, some cash accounts, such as bank CDs and deposit accounts, may offer FDIC insurance. Others do not. Be sure you understand the type of protection available with each one. The advantages of investing in cash alternatives are evident. You receive reliable, predictable earnings, i.e. through interest, and an easily tapped source of funds with little risk to principal. The big trade-off here, though, is that the return you'll receive on these investments is relatively low compared to the potential return offered by other investment options. In fact, the possibility exists that the return on these investments won't even be sufficient to keep up with inflation. If that's the case, you'll actually lose purchasing power over time. So let's move on to bonds. Bonds are essentially loans, which is why they're called debt instruments. You, the investor, lend money to a government or a corporation. The interest rate or coupon rate, which can be fixed or floating, is set in advance, and interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is fixed as well, ranging from 1 to 30 years. However, bonds don't need to be held until they're mature. Once issued, you can actually trade them among traders or among investors, like any other type of security. Because you can buy or sell bonds in the open market, the bond prices do fluctuate, selling at, above, or below their face value. If interest rates rise, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing. So when interest rates rise, existing bonds generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. Generally, the longer a bond's duration to maturity, the more volatile its price swings. The most common types of bonds in the US include US government securities, agency bonds, municipal bonds, and corporate bonds. US government securities are backed by the full faith and credit of the United States government and therefore carry minimal risk. We've already talked about US Treasury bills. Other Treasury securities include Treasury notes and Treasury bonds, which both pay interest semi annually. You can also invest in bonds that are issued by agencies owned or sponsored by the US government, which may or may not have backing from the US government, depending on the agency. Municipal bonds are issued by local governments or states, cities, or towns. Specific authorities, like a state transportation authority, may also issue bonds. Corporate bonds are issued by private companies, and the volatility of these bonds depends on the companies that issue them and can range from very stable to highly volatile. These are sometimes called high yield bonds or junk bonds. Some corporate bonds are convertible and can be exchanged for shares of company stock. You can also purchase what are called zero coupon bonds that are issued at a discount below face value. So with these, no interest is paid consistently, but at maturity, you receive the face value of the bond. So for example, you may pay $600 for a 5-year, $1,000 face value zero coupon bond, and at the end of that 5-year term, you would receive $1,000. So what are the pros and cons of bonds as an investment choice? Let's take a look. So bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodities, but they are an important component of most investment portfolios. Bonds can provide a steady and predictable stream of income through interest payments for as long as you hold them. In addition, the income from interest payments is typically higher than that for cash alternatives. Bonds are generally considered lower risk investments because bonds are legal debt obligations. Corporations must pay interest to bondholders before paying dividends to shareholders. Further, in the event a corporation declares bankruptcy or dissolves, it's obligated to pay bondholders before stockholders. And of course, securities issued by the Treasury are backed by the full faith and credit of the US government. However, all bonds carry some risk, and some bonds, for example, high yield bonds, carry a great deal of risk. Bonds may also help you to diversify your investment holdings. Bond values tend to move in the opposite direction of the stock market. So what that means is they have what's called a negative or low correlation with the stock market. By holding both bonds and stocks in a portfolio, you might be able to offset losses in one asset category with gains in another asset category. With a bond, you can lose money if the issuer fails to make interest payments or is unable to repay principal. Bonds can also lose market value if the credit worthiness of the issuer declines. For example, if the issuer begins having financial difficulties or if its bonds are downgraded by rating services. This is the type of risk associated with or associated more with corporate bonds and less with Treasury securities, which are backed by the full faith and credit of the United States government. Many bonds are issued with a fixed interest rate. As general interest rates fluctuate, so too will the value of fixed rate bonds. If interest rates drop, new bonds and investment options issued will offer lower interest rates, and the market value of existing fixed rate bonds is likely to increase. Conversely, an increase in interest rates will generally cause a drop in the value of existing bonds. Note, however, that not all bonds have fixed interest rates. Bonds that have floating interest rates will tend to fluctuate less in value when interest rates change than bonds with fixed interest rates. Finally, because bonds have relatively lower risk than other investments such as stocks, they also tend to offer relatively lower returns. So stocks, when you buy a company stock, you're actually purchasing a share of ownership in that business. And the greater number of shares you own, the higher the percentage of ownership you have in that company. Investors who purchase stock are also known as company shareholders or stockholders. And your percentage of ownership in the company also represents your share of the risk taken and profits generated by the company. If the company does well, your share of the total earnings will be proportionate to how much the company's stock you own. The flip side, of course, is that your share of any loss will be similarly proportionate to your percentage of ownership, though you're not personally and financially responsible for any share of the liabilities of the company in which you hold an equity interest. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividend payments, which can generally receive either in cash or additional shares. Capital gains payouts and other corporate privileges. For example, common stockholders have the right to vote for candidates for the board of directors and on other important issues. If you purchase stock, you can make money in one of two ways. First, corporate earnings may be distributed in the form of dividends, usually paid quarterly. Secondly, you can sell your shares, and if the value of the company's stock, has increased since you purchased it, you will make a profit. Of course, if the value of the stock has declined, you will lose money. Generally, corporations may issue two types of stock. They issue what's called common stock and preferred stock. Common stockholders hold many rights, including the right to vote. However, common stockholders are the last in line to claim the earnings and assets of the company. They receive dividends at the discretion of the board of directors, and only after all other claims and profits have been satisfied. Preferred stockholders are given priority over holders of common stock, and when it comes to dividends and assets. However, preferred stockholders do not receive all the privileges of ownership given to common stockholders, including the right to vote. Preferred stockholders typically receive a fixed dividend payment, usually on a quarterly basis. For preferred stockholders, there is less return potential than for common stockholders. There is also less risk. The common stockholders benefit more when the company does well, but they may lose more if the company does poorly. Stock is commonly categorized by the market value of the company that issues the stock. For example, large cap stocks describe shares issued by the largest corporations. Other general categories include small cap, mid cap, and micro cap. Stock is commonly classified according to the characteristics of the company and or the expectations of investors. For example, growth stocks are usually characterized by earnings that are increasing at a faster rate than their industry average or the overall market. These are often in a new or fast-growing industry and frequently have the potential to give shareholders returns greater than those offered by the stocks of companies in older and more established industries. Growth stocks are among the most volatile classes of stock, however, and have significant risk of losses. Value stock is typically characterized by selling at a low multiple of company sales, earnings, or book value. Income stocks generally offer higher dividend yields than market averages and typically fall into the utility and financial sector, as well as other stable and well-established industries. Blue chip stocks are the stocks of large, well-known companies with good reputations and strong records of profit growth. They also generally pay dividends. Also worth mentioning are what's called American depository receipts, which are negotiable instruments created to represent shares of stock and sometimes bonds in non-US companies. So the advantages of investing in stocks depend largely upon the stock or the type of stocks that you choose. In general, though, stocks offer a great potential for returns than do bonds or cash alternatives. Historically, this has been particularly true for long-term periods. With stock, you actually own a share of the company and therefore have ownership rights that may include voting rights. You can invest in stock that has a history of paying regular dividends, You can also invest in stock that has the potential to appreciate significantly in value. And stock is easy to buy and sell. Of course, if the company you invest in performs poorly, it may not pay dividends, even if it had regularly paid dividends in the past. More importantly, though, poor performance may result in your shares losing value. In fact, your shares can lose value simply because they're subject to the general volatility of the stock market, which has experienced sharp declines in the past. This volatility means that your risk of losing principal is greater with stock than it is with bonds and cash alternatives. It also means that the stock may not be appropriate for short-term investment timelines unless you have a very high tolerance for risk. So cash alternatives, bonds, and stocks are the three major investment categories. But within those categories, there are other options, including real estate, both commercial and residential, and real estate investment trusts, stock options, futures and commodities, which amount to speculating on the future value of something. Oftentimes we see things like gold, sugar, wheat, and other examples. And collectibles such as antiques, fine art, or anything that may appreciate in value over the years. Because this is an investment basis discussion, we're not going to spend any time on these other investments. But if you want to reach out to me later, we can discuss them in person if you like. So mutual funds represent another way to invest in stocks, bonds, or cash alternatives. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment strategy. The fund is managed by a fund manager who reports to a board of directors. By investing in the fund, you own a piece of the total portfolio, which could include anywhere from a few dozen to hundreds of securities. This provides you with both a convenient way to obtain professional money management and instant diversification that would be more difficult or expensive to achieve on your own. Every mutual fund publishes a prospectus. Before investing in the mutual fund, you want to get a copy of that and carefully review the information that it contains, such as the fund's investment objectives, their risk, the fees, and the expenses. Carefully consider those factors as well as others before investing. We've discussed three major investment categories, cash alternatives, bonds, and stocks. Many mutual funds limit themselves to just one of these categories, commonly named and classified according to their investment style or objective. Funds that invest solely in cash alternatives are generally called money market mutual funds. Funds that invest solely in bonds are called bond funds, and not surprisingly, funds that invest in stocks are called stock funds. Stock mutual funds can also be classified based on the size of the companies in which the fund invests. So again, it's that large cap, mid cap, or small cap. Of course, there are many other types of mutual funds. For example, funds that invest in both bonds and stock are often called balanced funds. In fact, there are mutual funds that fit all along the risk spectrum. International funds, which seek investment opportunities outside the United States, are one example. An actively managed fund is one where the fund manager uses his or her knowledge and research to actively buy and sell securities in an attempt to beat the benchmark. A passively managed account, called an indexed fund, typically buys and holds most or all of the securities represented in a specific index. A really common one is the S&P 500 index. The objective of an index fund is to obtain the same rate of return as the index it mimics. Although the name of the mutual fund sometimes offers insights into its investment style and objective, don't rely on the name alone to determine whether you want a fund to invest in that fund. You should also read the fund's perspective before you consider investing. Mutual funds offer several advantages. Diversification is one of those. Most mutual fund owners owns dozens or even hundreds of securities. Managers often spread fund assets over more than one industry or even more than one type of investment. Through diversification alone can't guarantee a profit or insure against a loss. Holding many different securities reduces the risk of the impact of problems with a single individual security. If some of the fund's holdings perform poorly, they may be offset by others doing well. Professional money management. So, full-time expertise is part of what you pay for in buying shares of an actively managed mutual fund. These fund managers analyze hundreds of securities, both current and contemplated holdings, and make decisions on what and when to buy and sell. Small investment amounts, depending on fund rules, you can open an account and make subsequent distribution or contributions with as little as $50. You can even set up an automatic investments to transfer funds from your bank account into the investment there. Liquidity, you can convert your mutual fund investment into cash by selling your shares, by making a request to the fund company in writing, over the phone, or on the internet on any business day. On the other hand, mutual funds are not guaranteed investments, and the price of mutual fund shares can change daily. And you'll receive the current value of your shares when you sell, which may be more or less than what you paid. In addition, because investors in a mutual fund can withdraw their funds at any time, mutual funds tend to keep an amount of portfolio dollars in cash alternatives to accommodate day-to-day withdrawals. These funds could be invested in investment options more suited to the fund's investment strategy. Also, fund managers don't take into account your individual financial circumstances. So what this means is they aren't obviously considering you when they're making these investments. This can lead to some inefficiency, particularly when it comes to taxes. For example, any short or long-term gains in the mutual fund that the mutual fund realizes from the sale of securities is passed through to investors, even if the investors don't receive any distributions from the fund. You can't control the timing. Finally, all mutual funds have expenses that investors must pay for. These include sales charges and the annual operating expenses of running the fund. And you can find out more about these fees, usually calculated as an expense ratio in the fund's prospectus. Please read the prospectus carefully, as fees and expenses affect the fund's return. The higher the expense ratio, the more likely the fund's return will be lower than a similar fund with lower expenses. Like a mutual fund, an exchange traded fund pools your money with the money of other investors and invests in a collection of securities. However, there are some key differences you need to understand. Unlike actively managed mutual funds, exchange traded funds typically select investments according to a specific index. For example, the S&P 500, the fund's investment choices typically don't change unless the index itself changes. That passive management style and relative infrequent trading can help reduce the fund's cost for such things as management fees, research into individual securities, and trading fees for buying and selling individual securities. In this way, they are a bit like an index mutual fund. Yeah, even if ETFs may have passive management style, they can be useful to investors who want to trade actively. For example, an ETF can be traded throughout the day, and its price may fluctuate as a result of that activity, just as a stock does. This is different from a mutual fund, which is priced only once a day and after the market closes. Also, an ETF can be bought on margin, sold short, or traded traded using stop orders and limit orders, just as a stock can. ETFs are one way to invest in an individual market segment or industry without limiting yourself to a single stock or bond. Finally, because they trade relatively infrequently, ETFs may offer tax efficiencies. For example, they may make lower taxable annual distributions to shareholders. Like a mutual fund, each ETF publishes a prospectus. Get a copy before investing and carefully review the information it contains. Even if two ETFs invest in the same market segment, they may use different indexes that are structured differently. As with the mutual fund, before investing in an ETF, get a copy of the prospectus available from the fund and carefully review the information it contains, such as the fund's investment objective, risks, fees, and expenses. Carefully consider those factors as well as others before investing. Many investors utilize an investment strategy. It's called dollar cost averaging. And with this strategy, rather than investing a single lump sum into you invest smaller portions of that sum over time, regularly at consistent intervals. And this doesn't matter how the market's doing, you just do it over and over again. Your goal here is to reduce the overall volatility of your portfolio by purchasing more shares when the price is low and fewer shares when the price is high. Although dollar cost averaging can't guarantee you a profit or avoid a loss, a regular fixed dollar investment may result in a lower average price per share over time, assuming you continue to invest through all types of markets. You should consider your financial ability to make ongoing purchases regardless of price fluctuations, however. For example, let's say that you decide to invest $300 each month toward your child's college education. Because you invest the same amount each month, you automatically buy more shares when the prices are low and fewer shares when the prices are high. Over time, you'll find that your average cost per share is actually less than the average market price per share over time that you invested. If you're currently contributing automatically to a 401k plan at work, you're actually already participating in dollar cost averaging. It's an almost universally accepted concept that any portfolio should include a mix of investments. That is, a portfolio should contain investments with varying levels of risk to help minimize exposure. Many investors make the mistake of putting all their eggs in one basket. For example, if you invest in one stock and that stock goes through the roof, a fortune can be made. On the other hand, that stock can lose all its value, resulting in a total loss of your investment. Diversifying your investment over several asset classes will help reduce your risk of losing your entire investment. Keep in mind, though, that diversification cannot ensure a profit or guarantee against a loss. Asset allocation is one of the first steps in creating a diversified investment portfolio. And asset allocation is the concept of deciding how your investment dollars should be allocated among broad investment classes, such as stocks, bonds, and cash equivalents. The underlying principle is that different classes of investments have shown different rates of return and levels of price volatility over time. Also, since different asset classes respond differently to the same news, your stocks may go down while your bonds go up, or vice versa. And diversifying your investments over different asset classes may help you lower the overall volatility of your portfolio. So, how do you choose the mix that's right for you? A number of resources are available, including interactive tools and sample allocation models. Most of these take a number of variables, some objective, such as things like your age, your financial resources available to you, your time frame, your need for liquidity. And some of these are more subjective things like your tolerance for risk, your outlook on the economy, and suggest a possible allocation mix for you. You'll want to choose a mix of investments that has a potential to provide the return you want at the level of risk you feel comfortable with. For that reason, it often makes sense to work with a financial professional to gauge your tax tolerance, or I'm sorry, your risk tolerance, and then tailor your portfolio to your risk profile and financial situation. So every individual situation is unique, and nevertheless, in general, conservative asset allocation models will invest heavily in bonds and cash alternatives with the primary goal of preserving principal. In comparison, a moderate allocation model will attempt to balance income and growth by allocating significant investment dollars to both stocks and bonds. And finally, an aggressive asset allocation model will tend to concentrate heavily in stocks, focusing on potential growth. As you've seen here, there's a lot to consider when it comes to investing. And if you don't have time, confidence, or the inclination to put together an investment plan, you may benefit from help of a financial advisor, a financial professional such as myself, to help determine the investment goals, timelines, or risk tolerance. We evaluate the markets and investments to find the best fit for you, We also work with you to create an overall plan, such as one of the asset allocation models we discussed, or select specific investments to kind of fit in those different investment options. We will also help you manage your portfolio over time, and we'll make modifications there when necessary. So I just want to say thank you for letting me have the time here to talk. And also, I have my information here on the screen. You can reach out to me by phone, email, or also that QR code right there. If you scan that with your phone while it's on the screen, you can actually schedule a time to meet with me right here at our East Main Street branch in Murfreesboro. Rachel, you want to work through some questions here?
Yeah, absolutely. And thank you so much, Lee. That was a lot of helpful information.
It was a lot to go over.
It was a lot, but you know what? That's good. It's we can always go back and reference it too. So,
Absolutely.
so here's one of the questions that somebody has. If someone wants to start investing today, where should they start?
Yeah, great question. So a couple different things you can do if you're looking to start on your own. Mutual funds and ETFs are a great place to start. As you heard me talk about there, they can be diversified and find a whole lot of different allocations to set those up. But if you're not the type of person who wants to do that yourself, you can always contact me. Scan that QR code right there, set up an appointment with me, and we will get together and kind of talk through your different needs and also work to set that investment portfolio up for you.
Right. Another one was, how does one invest in the S&P 500?
That's a great question. Probably the most common and easy way. So what we first say, you can't directly invest in an index. So there is no way to go on to an investment platform and say, I want to buy shares of the S&P 500. What you can do is what I was discussing earlier. The most common and most easy way to do it is either an index mutual fund that is based on the S&P 500 or an index ETF. It depends on your investment style and what you're looking to accomplish. So an ETF can be traded in real time, where a mutual fund cannot. And I can help you with that too if you want to look at different options there.
Got it. Are there programs that support startups with funding or investments, or startups for small businesses?
That's a good question as well. That would be probably a really good question for like our business team here to send or other financial institutions. They could potentially have a program like that. That's a little bit outside my scope. So I'm not sure specifically what you're looking for. But also, again, if you want to reach out to me on a more personal conversation, we can have that as well.
Great. Then we have one last question. What is the website to determine your Social Security income when you fully retire?
That's one of my favorites. I'm glad you asked that, actually. So a lot of people don't know this, but the Social Security Administration has a website that links directly to them. So it's ssa.gov. So that stands for Social Security Administration.gov. So if you type ssa.gov, you'll have to create a profile with them, and then you'll work with that profile to set up your Social Security pay. So what that will show you is your Social Security estimated benefit at three different time frames. At 62, your full retirement age, which is determined by your birth year, and then at 70. And so full retirement age is kind of the optimal, if you will, retirement benefit from Social Security, at least what they've determined that to be. And then the earlier you take it, you lose a little bit of that benefit, and the later you take it, you get a little bit more. So how you determine your Social Security benefit and when to take it, that's a conversation for another time. Feel free to reach out to me, and I'll help you determine that. But that is how you do that.
We've got about two more questions. We still have some time. Is it good to go ahead and do that?
Sure. If y'all are good. Yeah.
Okay, great. Let's see. Your thoughts on a 60-40 stock bond allocation for most people?
Yeah, that's a question that I would say, that's a conservative portfolio, moderately conservative. For a lot of people, that would be appropriate, but there again, it just depends on your specific circumstances and where you're looking to accomplish. So that's one of those questions that comes down to a really good personal conversation that we can determine if that's appropriate for each individual. But yeah, it's probably a good fit for most people. Sure.
Right. Lee, thank you again, and thank you all for joining us. I really appreciate it. And
Thank you, Rachel. I appreciate your time.
thank you, and have a wonderful afternoon, everybody. Thank you.
Hi, everybody. Thank you so much.